Welcome back, future retirees. This is Dr. Jeff Wilson coming to you from our fabulous Freetirement studio right here in sunny Southern California. Today we're going to be taking a look at tax-smart retirement investing. So investing wisely involves a careful understanding of asset classes and the strategies associated with them. It's crucial to comprehend the impact of taxation on these assets and the importance of effective asset allocation. This module delves into the world of pre-tax, Roth, and after-tax investments, giving insight into how they can help shape your financial portfolio. Investments can be broadly categorized into three types based on taxation. So there are pre-tax, as we mentioned, and Roth and after-tax investments. Pre-tax investments refer to contributions made before any taxes are deducted. Money invested in these accounts grows tax deferred, meaning you pay taxes only when you withdraw during retirement. Common examples include traditional IRAs and 401k plans, and for some of you, 403b plans. Roth investments, the second category, involves contributions made after taxes have been deducted. The advantage is that qualified withdrawals, including earnings, are tax-free. Roth IRAs and Roth 401ks are popular examples. And then our third category, after-tax investments, involve contributions made with already taxed income. Although gains from these investments grow tax-deferred, the growth is taxable upon withdrawal. Non-deductible contributions to IRAs or non-qualified annuities are instances of after-tax investments. So proper asset allocation is key to achieving financial goals and managing risk. It involves distributing your investments among different asset classes, like we talked about last video, stocks and bonds and cash, based on your risk tolerance, your financial goals, and your time horizon. Let's explore the main asset classes and their characteristics. So asset classes are fundamental categories of investments, each with its risk and return profile. Diversifying across multiple asset classes is a strategy to mitigate risk and enhance your potential returns. So stocks represent ownership in a company, as we've talked about, and are known for potential high returns, but also significant volatility. They can be further categorized based on the size, small, medium, large cap, remember talking about that, and investment style, value, blend, growth. Bonds are debt securities where you lend money to an entity like the government or a corporation. They offer regular interest payments and return the principal at maturity. Bonds vary in terms of duration. There are short, intermediate, long-term bonds, and they also diversify by credit quality, junk, investment grade, right? Mutual funds pool money from multiple investors to invest in diversified portfolios of stocks, bonds, or other assets. They provide an opportunity to invest in a variety of securities, even with a smaller investment. And then there's something called exchange-traded funds, or ETFs. And they are similar to mutual funds, but are traded on stock exchanges like individual stocks. They offer diversification and liquidity, allowing investors to buy and sell throughout the trading day. So if you want to know more about what we've just discussed, or you need to review some terminology, I do want to bring your attention to a glossary in your workbook. Take a look at it. You'll enjoy reviewing those terms. Now, let's explore how each asset class is taxed and the implications this has for investors. Stocks represent ownership in a company, and their taxation varies depending on the holding period and whether they pay dividends. Generally, when selling stocks, you may incur capital gains tax. If stocks pay dividends, those may also be taxed. Long-term capital gains apply if you hold a stock for over a year before selling, right? The gains are taxed at the favorable long-term capital gains tax rates, however. Short-term capital gains apply when stocks are held for less than a year and are considered short-term, and they're taxed at your ordinary income tax rate. Dividend income is typically taxed at specific dividend tax rates, which can be lower than ordinary income tax rates. Bonds, being debt securities, have different tax implications, especially concerning the interest income they generate. So interest income from bonds is taxed at your ordinary income tax rate, which can be relatively higher than capital gains tax rates. Now, some bonds, like municipal bonds, they offer interest income that is tax-free at the federal level and often at the state level too, making them attractive for certain investors. Mutual funds pool money from various investors to invest in a diversified portfolio. The tax implications depend on the fund's activity and the type of income generated. Mutual funds may distribute capital gains to investors based on the fund's trading activities. These gains are taxable to the investors. If the mutual fund distributes like dividends from its holdings, these dividends are taxable to the investors as well. ETFs are similar to mutual funds, but they trade on stock exchanges. So they offer tax advantages due to their unique structure known as in-kind creation and the redemption process. Exchange-traded funds, or these ETFs, are typically tax efficient because of the in-kind process, minimizing capital gains distributions, which can be advantageous for long-term investors. So understanding these tax implications is essential for effective tax planning and optimizing your investment returns. Investors can employ various strategies to minimize their tax liabilities and enhance after-tax returns. For example, choosing funds that are tax efficient, like index funds or ETFs, which often have lower turnover and capital gains distributions, can significantly lower your tax burden and keep your hard-earned dollars working for you. Furthermore, holding investments for the long term can help you qualify for lower capital gains tax rates. Reducing the tax impact on your returns is the key here. Now, another strategy commonly utilized by the pros is something called tax loss harvesting. This involves realizing capital losses to offset capital gains. Now, in practice, your portfolio will likely have some winners and some losers. Strategically selling holdings with long-term capital gains with long-term capital losses will reduce your overall tax liability. However, be mindful of IRS rules regarding this strategy, such as the wash sale rule, which states that if an investment is sold at a loss and then repurchased within 30 days, the initial loss cannot be claimed for tax purposes. So beyond asset allocation, defined as how you choose different asset classes within your portfolio, another significant but often overlooked key to a successful tax mitigation strategy is asset location. So asset location explores the registration or taxation of the various account types. You can have the same exact mutual fund in an IRA versus a brokerage account, and they will be treated very differently when it comes to their tax implications. A simple roadmap to follow is first maximizing your tax advantage retirement account. Then, identifying your highest appreciated assets and exploring tax mitigation strategies such as charitable remainder trusts, something we're going to talk about much more later. When it comes to your taxable accounts, you may utilize tax-managed funds, which are designed to minimize tax impact by actively managing the portfolio with tax implications in mind. This is aiming for after-tax returns. If you prefer to buy your own individual securities rather than investing in a mutual fund, you might want to consider tax-inefficient assets like bonds in tax-advantaged accounts and tax-efficient assets like stocks in taxable accounts. This will optimize your tax treatment. High-flying growth stocks are best suited in a Roth IRA, whereas actively managed mutual funds with high turnover are best in tax-deferred accounts. So the ongoing trading activity does not create undue tax burden for you as the investor. Staying informed about tax law changes is also critical. Tax laws evolve, impacting investments. You need to stay updated on tax reforms and adjust your investment strategy accordingly. Understanding and implementing these strategies can significantly enhance your after-tax returns, providing more funds for reinvestment and achieving your financial goals. When it comes to deciding where you focus your attention and effort, I like to think about a Venn diagram of all the things that matter versus all the things you can control, and focusing our energy only where the cross-section happens. If we only focus our effort on things that matter and we can control, we can realize a much more favorable outcome, which alleviates undue anxiety and uncertainty. The exact outcome of our investments is usually outside of our control, but the taxation of those assets not only matters, but is something we can absolutely control. If you are not as comfortable with tax laws, we often recommend investors to consult with a qualified tax professional. A good CPA is worth their weight in gold, right? Investing wisely involves not only selecting the right assets and diversifying your portfolio, but also being mindful of the tax implications. Each asset class comes with its own tax considerations, and employing tax-efficient strategies can make a substantial difference in your overall returns. Remember, taxes are a crucial part of the investment landscape, and proactive tax planning can preserve your wealth and help you reach your financial objectives. As you continue your investment journey, keep learning about tax-efficient investing to optimize your financial success. This is Dr. Jeff Wilson, hoping you are thriving in life, living well in every moment, and sharing your prosperity with those you love. Cheers to your incredible journey ahead.